Good afternoon. Now I'm going to show you how to add accounts receivable to our spreadsheet. Okay. For our spreadsheets were not realistic because they had no accounts receivable, no accounts payable. Now we want to make them more realistic. So we're going to start out with a heading. So I have accounts receivable. If I misspelled his words, please forgive me. The next line is a beginning balance. Then the next line is what items make accounts receivable increase, and what makes accounts receivable increase are sales. The next line is what makes accounts receivable decrease, which are cash receipts. So we have a line for cash receipts, and that's just a header line because we're going to break our cash receipts into two pieces. One is cash received in the month of sale. So month of sale. And then subsequent month. And then total cash received. And then ending balance. Okay. Now we're going to do several of these tables. We're doing one for accounts receivable, accounts payable. We're going to do one for depreciation, loans payable. Each of these tables has the same concept. Different words maybe, but the same concept. What we are trying to do is set up in vertical format what a T account looks like. So we always start with the beginning balance. Then the next line will always be whatever makes it get larger, then whatever makes it get smaller, then total of that, and then an ending balance. They all will be the same. Okay. Now, in order for us to have receivables, we have to have a methodology for collecting our receivables. We can't collect them all at once because then we have no receivables. So we're going to use a 70-30 percentage, meaning 70% in the month of sale, 0.70, and then the other 30% in the subsequent month. And to make sure that we never try to collect more than 100%, we're going to link this to this so that it will always add up to 100%. And the way we do that is we just put a little formula in saying this is equal to 1 minus this, so that it will always equal 100%. So if I change this to 0.6, that'll be 0.4. Okay, so just a little trick that we use. Now this 0.7 is a variable, so we need to paint it variable color, which is, as we know, green. Okay, so all activity starts in the first month. So our beginning balance is always in all of our tables, our beginning balance is always going to be the same as the ending balance. We end with a balance, and then the next month, that is the beginning balance. So we want to link this beginning balance to the previous month's ending balance, which is that. Okay, so this is the start of our table. And 0 is the beginning balance, and that's what it should be. These sales come from the income statement. So here's our income statement. Here's our total revenue. These are the sales in the first month. So we're going to link this cell to that cell, total revenue. 2,000. Cash receipts, that's just a header line. Cash receipts, so cash receipts are going to be in this month are going to be 70% of this amount. So we want to construct that formula. And we want to show those items that are decreasing our numbers as negatives. So this cash receipts is decreasing, so it should be a negative. So this will equal minus this 70%. And now we want to use absolute referencing because this will be dragged across, but this reference will always be here in this column, so we want to make this absolute referencing. So, we use F4 for that, and we multiply that by 2,000, and we have 1,400. So 70% times 2,000 is 1,400. When we're doing Excel, we always should make sure that we are getting the answers that we're expecting to get. And here, now this will represent the cash receipt from the previous month's sale. So we have no sales in the previous month, but we want to make the formula set it up correctly. So this will be equal to minus 0.3, and we use F4 times the previous month's sales. Now we have nothing there, but we do have a cell, and that would make the formula correct. And that's 0. So the total cash received is the sum of those two. So you can sum that up in whatever way you see fit to do. Just sum that up. 1,400. And then ending balance is going to be equal to our beginning balance plus the sales plus, or actually minus, but since we've set since we set the cash disbursements or cash receipts up as negatives, it'll be plus this number. Enter, and you have an ending balance of 600. Now, is this correct? Well, if we've collected 1,400 of the 2,000, then 600 is left as a receivable. So the next step is to drag this over if we can. We want to be able to drag things over as quickly as possible. So we drag this over one cell just to make sure everything is working correctly. There's the 600, that ending balance. This is the next month's revenue. 2,100 is 70% of that. This 600 represents the remainder of what was sold. Okay, so we have one problem here is this didn't come out as a negative. We wanted this to be negative. So I need to go back here and make sure that this is a negative number. Oh, it is negative. I'm sorry. I just need to format it properly. That's all the machine is. Formatting. Formatting is very important. So it did come out as a negative number. And now we have ending balance of 900. So is this right? Everything adds up pretty well. And so it looks good. You can drag this over. It's good. Looks like it's working. And now we can drag this over the rest of the way. So that's our table. The table is the easiest part of this. The most difficult part is getting this into the financial statements. So we have the table, wind up with $600 beginning balance, and at the end of all of this we have receivables of 3,000. Okay? Now we have to get this into the financial statements. How do we do that? Now, if we move up to the financial statements, we look at the balance sheet. Obviously, we need to have a line for accounts receivable. So we need to insert something. And if we want to insert it in the proper place, we want to insert it above this fixed asset line. So we right click and we insert an entire row. And we say OK. And there's our space. So we type in accounts receivable. Okay, now, again, we have nothing in day one, but we do have something here. So there's our balance, place for our balance, and we're going to link this to our ending balance in the table that we just put together. Here's our table. Link to that. Make sure you always link it to the thing that you want. There's our balance. Now this has gone out of balance. You can see as it should. This is one of the advantages to having this alarm for out of balance, because it lets us know that whatever we've done has created an out of balance, and now it's up to us to put it back into balance. The next step, after we put an initial balance into our financials, we need to drag this over so that all of the ending balances wind up in our financial statements, and everything now goes out of whack, but we can fix it. We know how to fix it. Right now, what is the problem? Well, the problem is in cash from customers. That's the problem. The problem is cash from customers. When we were collecting everything, when we had no receivables, we collected $2,000 from our customers. But now we have receivables, so we haven't collected $2,000 from our customers. We've only collected, scroll down, $1,400 from our customers. The rest of it is a receivable. So this number, 2,000, is wrong, so we need to replace it. We want to make sure we have the proper signage. So in the table, this is a negative number, so we want a positive number here in the cash flow statement, so we need to make this a negative number. So equal minus, and then we scroll down. Make sure you pick the right number. It's the total cash received, 1,400. Scroll up, and you notice the red is going away. So obviously what we've done has worked. And if we take this number and scroll and drag it across, you can see that it's fixed all of it. So everything has been fixed. Okay? So that's fixed number one. There's another problem here, and that is in the cash flow statement. Cash is what's been changed, and cash needs to be adjusted. The cash flow statements need to be adjusted. Okay, so our direct statement of cash flow was adjusted. We adjusted it here, 1,400, but the indirect statement of cash flow needs to be adjusted. And what we need to do in the indirect statement of cash flow is take into consideration the changes in current assets and current liabilities. So we've had a change in current assets, which is our receivables. So we need to represent that in our indirect statement of cash flow. So we need to put a line in for change in accounts receivable. So we insert the entire row, say OK, and this is accounts receivable. And if we increase accounts receivable, that is an increase in accounts receivable is a use of cash. So we want to show that as a negative sign. So receivable increase or decrease. Okay. Now we need to represent the change in accounts receivable. The change in accounts receivable took place here. We went from this to this. So we want to put that formula in to this area, and we want to have a formula that's going to work in every month. And so we need to represent that change, and since it's an increase, receivables have increased, we need to show that as a negative number, since increases in receivables are a use of cash. So we need to do equal, and then this minus this will be a negative 600. Now, here's a problem. Our red didn't change, and it should have. And the reason it didn't was when you have to be very careful in Excel, because when you add lines to Excel, rows to Excel, sometimes total formulas at the end of the columns don't include it, what you've added. So that's what's happened here. If we look at this total here, and you hit the F2 key, which is the edit key, you can see that the formula doesn't include everything that it should. It doesn't include what we added in. So we need to adjust that. Okay, the easiest way to do that is to just drag that, hit enter, and you notice the red has gone away. So now we need to drag that across. And what we need to drag across is both of these. We need to drag that and that, since we changed the balances. So let's drag that one over and see what happens. You see that fixed that. And then drag this the rest of the way. And everything has been fixed. Okay. Everything is fixed. Now, the only problem left is a summary. So if we go over to the summary, okay, problem here is you have a hole in the summary. So this is what the accounts receivable that we added. You have a hole there. All we have to do is just drag this down to fix that. So that's fixed. And here is a problem with the total. Okay, and this needs to get dragged down. And this number needs to be fixed. It's total, you see it's not, that's the same line that we had before. Now we just need to adjust for that. Bring that down. Enter. If we look down, we see the red is gone. Right. So we have successfully added accounts receivable to our financials. We have a balance sheet, income statement which wasn't affected, statement of cash flow which reflects now $1,400 rather than the amounts that have been collected rather than the total amounts, and our indirect statement of cash flow. And we also have now our first table, our accounts receivable table. Okay, thank you so much.